Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about the bear trap and what exactly a bear trap is, um, what we should be looking for, how it works, and I'll give you my opinions around it. I think that we are in the middle of a bear trap for a lot of the um, commodities that we're in. And I'll describe kind of the entire cycle when this occurs, what it looked like in some of the stocks of previous cycles, so you guys get familiar with what a bear trap is and kind of how it plays out in the cycle. So this is obviously something that I do with the platinum members as well. This is actually a platinum member question. I'm just going to share it with everyone so everybody knows what's going on. But this is some of the information that people ask in the question and answer sessions. If you're a platinum member, finding-value.com if you want to sign up. And let's dive into it. So what I have behind me is there's four phases to this gigantic cycle. And this cycle repeats over and over and over and over. And I can show you what the cycle looks like on a chart. And this is driven by the fundamentals and herd mentality of humans pushing assets from undervalued to overvalued. And this cycle repeats over and over and over on a continuous loop. Now, a lot of people, they know this cycle as the Elliott wave theory. You get a first wave, the second wave's a pullback, a third wave, fourth wave's a pullback, and then a fifth wave. You go down at point number 2 here. That is considered a bull trap. And then it goes on down and down and down. So I'm going to interlink Elliott wave theory and the moves, and also interlink that with the cycle that continues over and over and over. So anyone who's watching this, hopefully you guys can get a little bit more familiar, at least to my knowledge and how I understand all this, of what the bear trap looks like. So if you were to look at this, it's basically 4 phases, and the 4 phases, much like the real estate cycle and all these different cycles, you have a recession on this side, this big decline here. The capitulation is recession. A recovery phase is usually this long recovery phase here. They call that the stealth phase. The expansion phase is when you start to get into the after the bear trap here is the expansion phase in here. And then at the top, you usually get a hyper supply phase of some sort. That is the real estate market. That is a commodity market. And that is basically the loop that this goes in. Other sectors are driven by other drivers. So a technology sector, if you're just looking at it from a big picture view, not an individual company that's going into a growth phase of a product that they sell in their S curve, but just the big picture phase for technology as a sector, this would be driven by interest rates and inflation. This would be an increasing interest rate environment. This would be a recovery phase for that, and this would be a declining interest rate environment coming on up here. So this would be, think of it as you go into a recession or a large sell-off. They do stimulus type money. The money comes into this system. Interest rates are still low, and this cycle repeats over and over and over and over. In Elliott wave, I would say that this here is generally the first type of wave. You get a bear trap, then you get 3 distinct moves in this coming on up, and then you get the big bull trap and sell-off. So if you were to kind of overlay this, this is the stealth phase, this phase that goes up and down. This is the bear trap, and then you get distinct moves within the wave 3. So if you look, you have smaller movements within a larger movement. And we can see that in the charts, and I can kind of show you what that looks like in some real charts. So what people do is this from bottom to top, it may take on a large secular bull market 10, 15, 20 years that scribes out this massive pattern over time. A lot of people are so focused, hyper focused on the short term that they don't even see the big picture of this big cycle. So a bear trap is when you get this first kind of major sell-off, everyone goes short, and then they get squeezed into oblivion on the upside. This happened to a lot of people in Tesla stock. A lot of well-known traders tried to short it, got trapped in it, and then got absolutely obliterated because they tried shorting during a market condition that was favorable for tech stocks. So that's kind of where they got hit pretty bad. So let's apply some of this to some charting so you guys can see what this is. And to kind of let you guys know, you usually see large, like very long basing patterns in the stealth phase. That's considered the gigantic base or the big consolidation period. That's what the level of despair is. I call it the valley of despair, is what I call it. And I'll show you what that looks like. I'll show you what this move up is. I'll show you what potentially could be a bear trap, and then what could be a big move behind it. Another thing that you can also do, since we have multiple sectors that should be doing opposite, a technology sector should be putting in a bull trap, while a commodity sector may be putting in a bear trap all at the same time. On this decline here and this decline here may sync up. The size of these pullbacks are different depending on what you look at. They can be anywhere from a 50% pullback for a bear trap, 30-something percent, or even all the way up to 80% of a pullback before a gigantic rip. And I don't think there's any clear distinction on what exactly the pullback will be. But generally speaking, if this is a fractal, the bigger the move up, usually they get a larger bear trap pullback before just rocketing higher. A lot of people get scared in the bear trap that are newer investors, and I don't blame them. It's going to feel like absolutely horrible in a commodity stock because the pullback is going to be gigantic. And I do think that we are coming into this first bear trap, and I think it'll probably bottom out. I don't know. If I were to take a guess, it could be any time right now, all the way into first quarter of 2023 at any point. But I think that's probably what's going on. And let's take a look. I'll try to describe all this stuff and show you guys. So what I have here is the CRB to S&P 500. At first, I'm going to just kind of go over what a bear trap is real quick so you guys understand. So let me blow this thing up real quick so everybody can read it. It says, a bear trap is a false technical indication of a reversal from an uptrending market to a downtrending one that can lure unsuspecting sellers. Bear traps can occur in all asset markets, including equities, futures, bonds, and currencies. And don't forget commodities. Bear traps can take the form of a downside market correction amid an overall bullish move higher. It is difficult, if not impossible, to tell if the downward correction will continue or to turn into a bear trap. So from a trading perspective, traders need to be cautious about their position size in case the overall uptrend reasserts itself. Now, this is from a trading perspective. The reason that I have confidence in a commodity is because we have a whole bunch more data backing it. Market deficits, we look at technical charting patterns from the big picture view. We understand Elliott wave theory. We look at also inventory levels. We look at cost curves. We tie this all together to ensure that the fundamental backing of the reason why these prices move up and down is either favorable or unfavorable. And you can have cyclical pullbacks in big secular trends. Secular is a long term. So you could have a down year in a gigantic bull market of commodities. So I'm going to pull up this CRB to S&P 500 ratio. This is the commodities divided by the Standard & Poor 500. we have a downtrend line. We've broken the downtrend line. And when you break a downtrend line, we call that a shift in the trading. It's a new paradigm where commodities will outperform. And this is where the debate will happen. This is where people will say, you know, this is kind of that first leg up. And we get this pullback here, and people will say it's done, it's over with. Commodities are completely done for. That's just what some people will say, and they'll give you reasons of, you know, we're going into a recession, and technically it's broken out of whatever. They tell you all these different things, and the big picture view, though, when you look at it, is the downtrend is broken to the upside, and that's a huge step. So this is basically the first step. If you were to look at this from a big picture view on a technical trading sense, the first step's to break it. The second step's to pull. You get a pullback usually, which we call a retest or backtest. Then you break the high, and you're in a new uptrend. So this is in an uptrending market. We have our first pullback here. This is the first pullback. Now, when we look and we look back to that, we've broken a downtrend. We start to take off. We have our first sell-off. It's a bear trap, most likely. Why is this a bear trap? Why would this be a bear trap? Well, we've got a ratio that's off the chart to the cheap side. Why would we end a commodity bull market before it really even started too much? Like, this is like the first, second, third inning, or whatever it is, whatever you want to call it. It's in the beginning of the game. So we still don't have the supply coming online. We still don't have the investment. We still have all these fundamental factors that do not signal a hyper supply phase in a commodity bull market. We have inventories that are extremely low, and they're getting worse, not better. So yes, the demand side can get hurt, and we can equal the supply and demand through destruction of demand. The problem is we don't have supply coming, and we want there's a bunch of demand for these commodities coming up for a variety of things. We'll call it renewables, electric vehicles, population growth, just a whole bunch of different things. GDP growth. And what's going to happen is we're going to pull on back to some point, and I'm not going to know the exact point, and then we're going to rip it because people are going to think that it's over with. They're going to get scared out of their stocks. I'm not getting scared because I'm comfortable with the deficits in the commodities, the inventory levels, and the ratios and where they're at in relationship to history. That's just knowing the history of the valuations of these assets in relationship to each other. So if I were to look at the commodity index, this is priced in dollars, and take a big picture view, I'm going to show you a couple of different things here so you guys can get a little bit more familiar with looking at this stuff. So what you see here is the Elliott wave pattern that I have in the upper left. This is the price action of this move. Now, these circles are your ratios. This through a buy point in 1999. This through a sell point in 2008. It could have been a little bit lower down here. I just put the peaks, and then I put the peak where we had a buy signal, massive buy signal. Now, I also had a buy signal down in 2019 as well. So I thought this whole area was a good spot to be looking for commodity type of investments. Now, we've got some glaringly obvious things here, and I'm going to try to go over as best I can. This is a consolidation period. The price went nowhere and just consolidated sideways before breaking a consolidation zone. That's one thing I wanted you to know. We have another consolidation of this entire consolidation here, where we went sideways to lower in a consolidation. A lot of the times you get a couple of humps in there. It's not all the time, but this has the 3 humps. We had a capitulation bottom sell-off, which happens at the end of a trend. Everyone gets all scared, people get all short, and then it rips it to the upside. So that's an end of trend move. You usually see these end of trend moves. So when you were to look at this, you'd say, well, where is the stealth phase? Where is that expansion phase? Where is the bear trap? What does this all look like? And you could argue a couple of different things here for this. You could say that this here is the lead-in pattern, and this is the bear trap here. This pullback of minus 29.18%. That could be the pullback, the bear trap, and then you have the big old move coming on up all the way to the top. You come on down, you get your bull trap here, or your bull trap there, and then you just kill all the bulls there. So the bear trap is here, the bull trap is there, and that's what it looks like for a cycle. Right now, we've pulled on up out of the consolidation zone, and we've pulled on back a little bit. A lot of people think that commodities are done. We're going to have this recession. And I do think that we are going to have a slowdown. We very well could have a recession and all of those things. Predicting it is very difficult. So the way I do it is if I have entry points that are all down here and in here and in here and probably more here and in here, you know, I'm still buying in a lot of these different areas and cost averaging in as I make money and buy. The thing that you want to kind of look at and look for is this trend done? So do we have a pattern that is signaling an end of trend type move? And I know that can be somewhat difficult, but in my opinion of what this looks like to me is that this, another way that you can look at this as well is that this move here is this move here. And if you were to look at the pullback size of this bull market, or last bull market, this pullback was about 30% from top to bottom. Right now, we're at about 20% of this pullback. Could it pull back further? I mean, yeah, it could. And maybe it doesn't pull back any further. That's the part that's the hard thing. There's no, you know, the pattern looks a certain way and humans behave a certain way, but it doesn't mean that the pullbacks are all necessarily the same. So the way that I view it is I'm going to stay long as the fundamentals are good, as long as the ratios are cheap, and I'm going to ride through it and accumulate on pullbacks like we have now. So that's kind of the strategy that I've developed. But this is what it looks like. Consolidation period, big fat run up, consolidation period, and we're getting a big fat run up, and we're getting a pullback within, I think, this big run up to the upside. That's my viewpoint on it. A lot of the times also, the way that this thing goes up, it'll hit certain resistance points, and we have a lot of selling pressure back here before where we hit a resistance point and pulls on back. So I think that we're entering potentially the first sell-off of this commodity bull market, which is considered to be a bear trap. That's the first sell-off. Then we're going to go into the media attention phase, the enthusiasm phase, and then go into the greed and delusion phase. I said that we were probably early in this, so we can look at specific examples. I'm going to pull up Camco, CCJ, for an example for everyone. So we can kind of look at what the chart looks like. So what I'm going to do is I'm going to go back to the old bull market so we can look at that. And the old bull market here, it started in 1999. This was 2000. So 99 was the commodities signal against stocks to be in a bull market. And a little bit later, you know, a couple months later, Camco joined the fun of this bull market. So we had the first kind of big move higher, and then we had a sell-off down. It went down 49%. This is going to scare a lot of people. This also correlates with the 2001 recession, the recession in stocks. And then we took that 49% hit, and then we just rocketed. And we still had very big pullbacks along the way. They weren't exactly easy. This isn't an easy ride. It's very volatile. And then you'll get your you know, like your first one. So what this is, an Elliott wave, if we were to take a look at it, is we've got our first wave here, the pullback, the third wave, the jumble, and then the fifth. And then this here is the big consolidation period that usually has 3 humps. Now, can you identify the 3 humps? Hump 1, hump 2, and then hump 3. And then you break out of it. So that's that big consolidation period that I talk about. That is your disinflationary period. That's what's driving it. And now we're coming into another inflationary period. That's why we broke out of this big consolidation zone. Now, we haven't broken out of this big line with a bunch of resistance going across. I was hoping we could, but we didn't. So what we're getting now is we could get a pullback for a bear trap. Now, this bear trap, again, I don't know necessarily how far this thing's going to pull back. I don't think anyone does. A lot of people do Fibonacci sequences. They go from the bottom to the top, and they say, well, maybe it can pull back about 50%, maybe 60.618. And sometimes in very bad markets, it could pull all the way back to 0.786, depending on the stock. Some small stocks have already pulled back that far. Some of the bigger ones may not pull back that far. Maybe they only pull back to 0.382. If that's the case, we've already hit the target zone. But we could still fall down to 0.5. We could go to 0.618. Those are all historically highly likely pullbacks in bull markets. Now, if I were to go back and I were to look at the last bull market, that pulled back 49%. That is what it pulled back. If we were to put a fib retracement on it, we go from the bottom to the top. We would have pulled back to we pulled back to 0.618. And that's where we kind of stabilized and moved higher. 0.618 is a pretty common area to pull back to. Now, if we were to pull back to 0.618 on this next pullback, if it were to do that, which it very well could, 0.618 would put us at about $16 a share on Camco. So that is still substantial downside if we get a selling pressure type move and we stabilize there and then generate a massive bull market, because everyone's going to think that this is a bear. It's going to be a bear market. Everyone's going to think it's a bear market. It's totally done. They're going to get all short, and then we're going to squeeze the shorts to the upside. Now, I'm not saying that we're going to go to the 0.618 zone at 1578 is what they've got. I don't know if it's going to go there. No one knows what price level. I mean, we could settle out right where it's at. We could settle out at 0.5. We could settle out in between them. Nothing is saying that it has to go to these levels. So it's possible that we get to the 0.618-ish area down in here, and you have to keep that open to possibility. I'm not necessarily calling for it, and I don't know if that's as far as we're going to go. Looking at the chart kind of zoomed in, we do have a lot of selling pressure. Bearish. There's a bearish engulfing pattern here, and there's some big selling pressure coming in. It very well could go down to levels that are down there. It's a possibility. And the way that my strategy is, I'm not going to sell out. I know that a big I think that we are in a big bull market in commodities, and there's no reason for me to sell out. I'm going to accumulate when this thing bottoms and starts to go back on up. Now, remember, a lot of this is driven by liquidity in the market. I don't know when something's going to break in the market. No one else knows where something's going to break in the market. No one outside of maybe the Federal Reserve and some insiders know when they would potentially will potentially inject liquidity into the system. No one knows exactly that moment or that time. We know that they're probably going to loosen their monetary, they're going to slow the rates of increase at some point here shortly. And that still could put pressure on this to go lower over the short term. Now, one of the things that we can use to see potentially where a bottom of a bear market might be, or I should say a bear trap might be, is we can look at something like gold. And gold is typically an indicator of liquidity in the system. And one could argue that gold has bottomed here in the 1600 level and has broken back to the upside in an upward fashion. One could say that liquidity, the gold market is saying liquidity could be coming very soon. That's why gold goes higher. When they printed all that money in 2020, what happened to gold? They printed all the money there. Gold rocketed higher to account for that money supply coming into the system. Then we went into a consolidation period. And now we are down. It looked like it was going to break here. We broke out of that nice little pattern there, but came back down and we could be breaking to the upside. Now, I don't know for sure. No one knows with 100% certainty, but that looks good. And then you can also look at copper. Copper is usually a signal, Dr. Copper, of a potential turning point. So what I'm saying is that if we look at copper here, we had the consolidation period here. That is your consolidation period, the 3 humps. We broke out of that consolidation period, and your first pullback is what? The bear trap. There's your bear trap in copper. The smart money was accumulating, at these bottoms here. And there's a lot of stocks that are still at bottoms depending on what sectors you're looking at. And we on the website are buying those at the bottoms and being patient and riding through pullbacks. Now, copper's already taken off. Are we seeing this as a signal that copper is our leader, that the economy is going to reopen in China, demand's going to come up? And that's what historically it's been. But I also know that copper is completely screwed in terms of its market deficits in the future. We also know that we're at very low inventory levels. But irrespective of that, I think this was a bear trap here, and we are going to rip it over time. Again, I don't know the path. I don't know if it's just going to go straight higher, guys. You could have pullbacks and zigzag and do all sorts of stuff, and those pullbacks could be of greater and lesser size. But this here, to me, looks like a very good move. Now, if we were to do a fib retracement on this and see what that level was, it pulled back to 0.5. It touched 0.618 briefly. 0.5 and 0.618 are common pullbacks. Same with 0.786 on the smaller little junior stocks. They kind of move down here. But this is moving higher. We'll see if it continues higher or if we get kind of an A, B, C type correction where we pull on back at some other point. If we zoom in, we already have kind of that so you usually get kind of a big round. You get an A, B, kind of C correction. Then you get kind of this hump lead in. You get a couple of humps here, and then you get another pattern that comes up. Usually, this to me looks like it could be bottoming. Now, again, I'm not going to be the expert on Elliott Wave. I don't want to pretend to be one. But we're going to watch this. If we break out of 3.94, if we break out of that, we are now in a new uptrend. By definition, what happens is you break a downtrend, and then you make a new higher high. And you could technically say this already did it, because you could say the downtrend's here, your breakout points there. You broke out, retest, and now we're moving higher. But it's looking quite good for copper. And I think this is the bear trap that we just went through. So some of these commodities could have already gone through the bear trap. Some are lagging behind. If we were to look at crude oil and the bear trap here. So here's crude oil. We are pulling on back here. Let's zoom in. So generally you get kind of these ABC type corrections. You get kind of a move here. This could be the AB, and then we get like a C correction or something like that. Now, where this thing ends, that's going to be anyone's guess. I can throw a fib retracement, but the fib retracement on this it's tough because oil traded to zero on a fluke. So what I'm going to do is I'm going to take the bottom here and do it from there. So if I were to take it and go up here, there's your peak. We are at the 0.5% level. and it's right on that level. So is this level going to hold at the 0.5 level? We're probably going to hold for a little bit, pause here, and we'll see if it holds. We could go down to $60 at 0.618 fib retracement level if we want, if the market pushes it down that far. That is a possibility. Now, this is in my opinion, this is a bear trap in crude oil. So if we were to look at this from a big picture view, I think that this move here, there's your first bear trap. This one here is going to be your first bear trap. And I'm still ultra bullish on oil and ultra bullish on commodities in general. If we were to do a fib retracement on, let me zoom in here a little bit better on this one. If we do a fib retracement on this guy here, let's see what that pulled back that last market here. So we come on up, we go to the top. It did a 0.618 fib retracement just underneath it, and then rocketed higher. And we didn't come back down to that level. So that one hit just below 0.618 on the fib retracement. But remember, the recessions and the moves are going to be different from these pullbacks. They're not all going to be the same, but 0.5, 0.618 is a pretty common area for a pullback in any sort of asset that I watch and see. So that's kind of what we're looking for. If I were to take a look at this pullback that we have, and we take a kind of a look at it, I can also take a bars pattern, and I'll just take the pullback here. Actually, let me delete that. I'm going to take, let me see if I can go back on a daily candlestick, because that'll give me a little bit more definition on this pullback here. So the pullback that we're seeing is this guy right here. So I'm gonna take this entire one and take that pullback. Now nothing's gonna look exactly the same here, guys. So I took that, I copied it. Let me go this. And then we're gonna overlay it just for the heck of it and see how this thing overlays. Now, if this were to be the same exact size, this is what it would look like. I've got a trend line component in here. This is saying that you could even potentially hit $50 or even in the 40s if it were to repeat exactly like it did last bull market. That is a possibility. And that's what it looks like overlaid to show you guys. Now, does that mean that we should sell everything and go in? I'm not. I'm just going to hold on. And a lot of the times I also see that we could pull back to this general vicinity in here where we've got some support. We've got some support. We've got all these support levels all through here. So I would think that this general level in here is pretty strong as you come into this support zone through here all the way back down to 62 even. There's a pretty good strong support level in that area, looking at previous price history. So to get down there, which is possible, you could come back and do a retest of this breakout. You'd have to have a external scare in the market. Now, looking back here, if you were to look where the support levels are, you could say the support level was about right here. So when you look at this, if we were to kind of look at this area here, the support level was in this general vicinity, right in this general vicinity where all of this trading occurred all through here. So it came back down into that support and then ripped it. So the way that I would view this, if I were viewing it, is I would take where the support levels are. And the support level to me, there's a good support level right where we're at. Here, here, here. And there's a very strong support level also in this vicinity in the $60 range. So I do think that it's possible that we can go back a little bit further. We may or may not, but we are coming into a support area. And that's generally where it's good to be looking, is where you have previous support that you can basically stand on. So that's what this looks like. We do have quite a bit of selling pressure on a monthly candlestick here. Again, we're in the beginning of this month, so we'll see what the rest of the month trades like. But that's kind of what I look for. This here is the bear trap, in my opinion. This is your first wave in a big, larger overall market. The fractal here, we can play with fractals too. If I were to do the fractal of last bull market, the bull market of this first wave and then the bear trap exceeded 4.236 to the upside. A lot of the times they go between 2.618 and 3.618. That's kind of where they stop, like in this general vicinity here. Now, if I were to project the fractal of using this fractal and see how big it could potentially be, I'm going to take the bottom here and go all the way to the top. And then let's say we bottom roughly where we're at. I'll say $70. And then we zoom out. We'll zoom out here. If we were to repeat what we did last bull market and go above it, you would actually go to a price that's about $600. If you were to repeat the last bull market and beating the fractal projection of 4.236. A very likely move for this next leg up could very well be around 370 all the way to 480, somewhere in that range is a possibility. I see it go up to that point a lot, 2.618. So that's what I've got for a projection. That's where I think we're at in terms of the cycle. I think that we are at this bear trap here and our first sell-off. And I think a lot of people will probably get short here. They'll get scared. They'll be scared from recessionary fears or whatever else. And this is what I would consider to be one of the best areas for a purchase, is when everyone is scared and I would be purchasing. Now, how do you know when the bottom is? The problem is you don't know when the bottom is. That's the toughest part about investing. So I bought in the stealth phase back here. I've been cost averaging in where I think there could potentially be bottoms. I'm buying off support levels is really what I'm doing. So one of the things that you can do is identify where the support levels are at and then look to see and purchase in those support level areas. And that's what I've been doing with a lot of the stocks out there. And I usually just cost average in a little bit. Again, that's not advice. That's just what I'm doing. So that's what I've got for today. That's what I wanted to share with everybody. Hopefully you guys have a better idea. At least you have a better idea of what I think and where we are in this big bull market of commodities. I showed you the big picture view. I showed you the consolidation zones and patterns. I showed you the first run up, the first pullback, why I think it's a bear trap. All of these sectors are going through it. You can even look at, I'll take a look real quick here. We can look at BHP just as an example for a larger diversified mining company for the heck of it. That also has the three humps, and we've broken out to the upside. That's usually the first step. And then what happens is we kind of sit down, come to the corner, and then we create a falling wedge, and then we break out of that wedge. This very much tracks a lot of the commodity prices like copper and other things. And this was one of our buy points in this corner over here, and a lot of these falling wedges that I find. I present them on the website as these falling wedges. You have to be patient because sometimes they can squeeze up and break. Sometimes they squeeze up, they kind of sit and go into a dead period, and then they just rocket. Sometimes they go like this. They create one last hump, gets everybody scared, pulls back a little bit, and then rockets like a rocket ship. That's where your fundamental analysis, ratio analysis, inventory levels of all the fundamentals all come into play. I am skewed. I'm looking at all these charts with a fundamental bias of a commodity bull market. I also see the big picture view. If we look at this, like the last bull market, just to show you guys, I know you're probably very interested in this because of the timing that we're in. So this here, I drew that completely wrong. It was probably done on logarithmic or something. I can just put it like this. We weren't in this long consolidation period here. We got the three humps. And then, this one didn't go all the way back. Sometimes this breaks up, sometimes this comes back middle, sometimes it goes all the way down. Again, I don't know the exact bottom, no one does. And then we ripped it. This was our first leg. So if we look at the first leg here, and we were go to the bottom, to the top, and then back. Now this thing really didn't pull back that far, if we look at it. But if we were to look at that, this one exceeded the 4.236 full projection. It exceeded it by quite a bit. So this was a massive bull market from this big basing pattern. So that was a big old run there for BHP. Now, if we were to take a look and we did a fib retracement on this, right? If we do a fib retracement on this, and then I were to zoom in on the fib retracement here, this retracement only went down to 0.382. A lot of the larger companies that I see don't fall back as much. Some pull all the way back. So I know I showed you Camco, and I said it's possible that it could go to 0.5, it's possible to go to 0.618, or it could go to 0.382, or somewhere in between. That is where I don't have my strategies developed off the probabilities, and since the probability it's not known how far this will pull back, and if the market conditions are good, and I think that we're going to continue in a big bull market, why would I sell out of something that potentially, if you look at this, has, I have to endure some pain in the short term for what is considered to be a life-altering investment from $13 all the way to maybe $70, depending on where you could get out. Highly likelihood you get out at 60 with a high probability there. So you're talking about a six-bagger on a company that is a very large company with a lot lower risk. And even if you bought, that's at $6. If you bought at the bottom of the bottom, that'd be a 10-bagger from the bottom, which is a massive move. And you're getting dividends along the entire way. Massive dividends. It's over a 10-bagger. It's probably like a 12 or 13-bagger during that time frame. So I don't chance trying to time it. I think that's just too risky. So I try to chance the timing of my purchases. I'm going to mess it up. I'm not going to be perfect. I'm a human being just like everyone else. But I think knowing the big picture view, looking at where we are potentially in the cycle, is what's going to give you a leg up on everyone else. So if you have any interest, definitely sign up. Finding-value.com, platinum membership. I go over some rocket ships, guys. Like some of these, they're harder to hold on because they're so volatile. You're going to have to get used to that volatility. You're going to have to toughen up a little bit. And we try to pick these bottoms. I use all the technical charting that I know. Again, I'm not like a professional to the T, but I try my best. I get the tailwinds, the macro tailwinds behind us, and that's where you can make a lot of money. That's where I've made all my money. That's how I've done it. Macro tailwinds, low valuations, buy when it's cheap, hold on, ride the bucking bull. That's with a B, guys, bucking bull. So that's what I've got. If you like the content, give me a thumbs up, subscribe to the channel if you haven't already. This is stuff that I talk about on the website with the Platinum members, question and answer sessions every once in a while. All right, guys, we'll catch you later. This is Finding Value.